Imagine waking up one day, opening your brokerage app, and seeing that a stock you bought because you believed in its story is now worth 10 times what you paid. Not because you're on Wall Street, not because you had insider info, but because you truly understood a simple everyday business that everyone else ignored. That's the world Peter Lynch invites you into in One Up on Wall Street. And that's exactly what we're going to unpack together in this episode. Welcome to this long-form, audiobook-style summary of One Up on Wall Street by Peter Lynch. In this episode, we're going to walk through the core ideas of the book in a warm, grounded, story-driven way. Just like a mentor sitting across from you at a quiet coffee shop, sharing decades of experience. By the end, you'll understand why the average person can actually have an edge over professional investors. How to think about different types of stocks instead of treating them all the same. What makes a potential 10-bagger and why those rare winners can change your financial life. How to research companies in a practical human way without drowning in numbers. And how to keep your emotions steady when the market tries to shake you out. This is not financial advice. It's education and perspective inspired by Peter Lynch's own lessons. Use it as a framework to think better, not as a shopping list of what to buy. So, let's step into Lynch's world. Peter Lynch managed the Magellan Fund at Fidelity and became a legend by delivering extraordinary returns over many years. But what made him special wasn't just his track record. It was his belief that regular investors, people like you and me, can beat the street by using an edge Wall Street often ignores. We live in the real world. We see products in our homes, in the supermarket, at the mall. We notice full parking lots, busy restaurants, new brands that people can't stop talking about. We see what's happening long before it shows up in an analyst report. Lynch's message is disarmingly simple. If you stay curious, do your homework, and stay patient, you can find great opportunities in plain sight. Let's start there. Think about your everyday life. Maybe there's a coffee chain in your town that always has a line out the door. Maybe there's a store your kids drag you into every weekend because they love a particular brand. Maybe you've used a software tool at work that quietly makes your team's life much easier, and you find out it's made by a company that's still relatively unknown. Most people just shrug and move on. Lynch says, pause, notice, ask yourself a question. If the business behind this experience is public, could this be an opportunity? That's the spirit of buy what you know. It doesn't mean you invest in every brand you see. It means your real life becomes your research radar. You start with what you understand, then you go deeper. Wall Street analysts often sit in offices reading spreadsheets and reports. You, on the other hand, are walking around inside the economy every day. You see the stores, you feel the trends, you hear what people are excited about long before it hits a formal forecast. That's your edge, if you use it. But Peter Lynch doesn't stop at buy what you know. He's very clear. Familiarity is a starting point, not a full strategy. You still have to do the work. You still have to understand what kind of company you're looking at. Because not all stocks are created equal. And this brings us to one of the most powerful frameworks in the book, the 6 categories of stocks. Lynch divides stocks into 6 main types, not to be fancy, but to help you set realistic expectations. If you confuse one type for another, you get disappointed, panicked, or greedy at the wrong time. Let's walk through them one by one. First, slow growers. Slow growers are companies whose sales and earnings increase just a little each year. Think of mature businesses in stable industries. They may grow at, say, 2 to 4% a year. They're not exciting. They're not flashy. What's the point then? Usually, they pay solid dividends. People buy them for income and stability, not explosive upside. If you buy a slow grower expecting it to triple overnight, you're going to be frustrated. The stock might gently rise. Maybe it keeps up with inflation, and you collect your dividend checks. That's the role it plays. Lynch's lesson: Know when you're dealing with a slow grower. It's like owning a sturdy oak tree in your financial garden. It won't grow fast, but it's hard to knock down. Second, stalwarts. Stalwarts are big, established companies that still have some growth. They're not young rockets, but they're not stuck either. Think of widely recognized brands that are leaders in their industry. These companies might grow earnings at, say, 10 to 12% a year. That's not thrilling like a startup, but when you combine steady growth with a reasonable price, stalwarts can be powerful investments, especially if bought during a temporary downturn. With stalwarts, you're usually not aiming for a 10-bagger. You might hope for 30 to 50% gains over a few years if you buy them when they're out of favor and sell them when they're fairly valued again. They're your solid middle-lane holdings, less thrilling, but comforting when the road gets bumpy. Third, fast growers. Now we're in the land of excitement. Fast growers are companies expanding rapidly, maybe 20, 30, even 40% earnings growth per year. They're often smaller, more nimble, with lots of runway ahead. This is where many of Lynch's legendary 10-baggers lived. But fast growth is a double-edged sword. The upside is huge. The risk is also higher. Growth can slow, competition can arrive, trends can shift. Lynch's advice: with fast growers, you must know the story intimately. How big is the market? How fast is the company expanding? Can they keep this up for many years, or is this a short-lived burst? When a fast grower is truly early in its journey, the upside can be life-changing. But impatience, overpaying, or buying late in the cycle can be painful. Fourth, cyclicals. Cyclicals are companies whose fortunes rise and fall with the economic cycle. Think of car makers, airlines, heavy equipment manufacturers, businesses that tend to boom when the economy is strong and struggle when it's weak. With cyclicals, the trick is simple to say but hard to execute. You want to buy when things look terrible but are likely to improve, and sell when everything looks amazing, but the cycle is near its peak. If you buy a cyclical company at record earnings right before a downturn, you can get crushed. The stock might look cheap based on that peak earning year, but those earnings may not last. Lynch wants you to ask, where are we in the cycle? Is this company about to benefit from a rebound or about to get hit by a slowdown? Cyclicals demand timing and awareness. They're not buy-and-forget stocks. They are more like tides. You need to know whether the water is coming in or going out. Fifth, turnarounds. Turnarounds are companies in trouble. They might have made big mistakes, taken on too much debt, lost a key product, or got crushed by competition. At first glance, they look terrible. And that's precisely why they can sometimes offer huge upside if the business genuinely turns around. Lynch looks for signs that a company is fixing its problems: new management, cost-cutting, a realistic plan, a strong core business that's still alive beneath the mess. But he's very clear, not every turnaround turns, some just go down. So with turnarounds, you're not betting on perfection, you're betting on survival and improvement. A company going from awful to average can still produce big returns if expectations were extremely low. Still, you have to be brutally honest. Are you seeing a real plan or just wishful thinking? Sixth, asset plays. Asset plays are companies whose real value lies in what they own, not in their current earnings. Maybe they own valuable real estate that the market hasn't fully appreciated. Maybe they have patents, natural resources, cash, or hidden stakes in other businesses. On the surface, they might look boring. But when you dig into the balance sheet, you find assets worth more than the stock's entire market value. Lynch loves situations where the company's assets provide a margin of safety, or where a catalyst might unlock that hidden value. With asset plays, the story is often about discovery. You're looking for something the broader market has not fully recognized yet. Why do these 6 categories matter so much? Because how you treat a stock should match what kind of stock it is. You don't expect a slow grower to act like a fast grower. You don't hold a cyclical the same way you hold a stalwart. You don't judge a turnaround by the same metrics as a steady compounder. If you mislabel a stock in your own mind, your expectations will be wrong. And when your expectations are wrong, your emotions go wild. You panic when you should be calm. You get greedy when you should be cautious. Lynch's quiet genius is giving you a language so you can say, "This is what I own. This is what I expect. This is why I'm holding it." That kind of clarity is priceless. Now let's talk about one of the most exciting ideas in the entire book, the 10-bagger. A 10-bagger is a stock that goes up tenfold. If you invest $1,000 and it becomes $10,000, that's a 10-bagger. Lynch's big insight is that you don't need 100 10-baggers to do well. A few spectacular winners can make up for many small mistakes, as long as you let those winners run. Most people do the opposite. They sell their winners too early to lock in gains, and they cling to losers, hoping they'll return to the price they paid. Lynch flips that. He'd rather prune the dead branches and let the healthy branches keep growing. If you find a company with a long runway for growth, expanding earnings, and a strong competitive position, and you bought it at a reasonable price, selling it after a quick double might be cutting yourself off from far greater potential. The key question becomes, is the story still intact? Are sales still growing? Is the business still gaining customers? Is management still executing? Is the balance sheet still solid? If the answer is yes, Lynch encourages you to hold on. 10-baggers are rare. They require time, conviction, and patience. But they're often found in places you already know. Local chains, niche brands, companies that solve real problems for you or the people around you. The secret is not magical stock picks. It's staying with excellence long enough for compounding to work its quiet magic. Of course, none of this matters if you don't do your homework. Lynch is very clear. Don't buy a stock just because someone mentioned it on TV, or because you saw a headline, or because a friend bragged about it at dinner. You owe it to yourself to understand what you own. He likes to ask simple, direct questions. What does this company actually do? How does it make money? What is its competitive advantage? How fast is it growing, and why? What could go wrong? You don't need PhD-level knowledge, but you do need a basic, common-sense understanding. If you can't explain the business in a few sentences that your friend or spouse could understand, maybe you don't understand it well enough to own it. This is what Lynch calls having the story for a stock. If the story is, this company sells boring products, grows earnings at a steady pace, and pays a decent dividend, that's a story. If the story is, this company is expanding rapidly into new regions with a product customers love and it has a long runway ahead, that's a story. If the story is, this company is in deep trouble, but a new management team is cutting costs and refocusing on its most profitable segments, that's a story too. When the stock price moves, you compare the price to the story. Is the move justified by what's actually happening in the business? If the stock falls, but the story is intact, maybe the market is just having a mood swing. If the stock rises, but the story is weakening, maybe it's time to be cautious. You're not just staring at a ticker symbol, you're tracking a living business. Now, let's touch on numbers. Lynch is not a pure spreadsheet guy, but he absolutely cares about numbers. He just cares about the right ones in the right context. Here are a few he pays special attention to. Earnings growth. He wants to see whether a company is consistently growing its profits, not just one lucky year, not just one pandemic spike, but a pattern of rising earnings. If a company is growing earnings at 15 to 20% per year, that can support strong stock performance. If the price you pay isn't absurd. Valuation. You've probably heard of the price-to-earnings ratio, or P/E ratio. It tells you how many dollars you're paying for each dollar of earnings. A high PE might be justified if the company is growing fast. A low PE might be a bargain, or it might be a value trap if the business is declining. Lynch likes to compare the PE to the earnings growth rate. If a company is growing earnings at 15% a year and the PE is around 15, that might be reasonable. If it's growing earnings at 15% and the PE is 40, he becomes skeptical unless there's some extraordinary reason. If it's growing at 15% and the PE is 7, he gets very interested. That suggests the market hasn't caught on yet. Debt. Debt is one of the silent killers in investing. A company with too much debt doesn't just have to grow, it has to outrun its interest payments. In a downturn, heavy debt can turn a survivable problem into a disaster. Lynch prefers companies with manageable debt. If the company has enough earnings and cash flow to service its debt comfortably, that's one thing. If the debt is towering over earnings, that's another story. He also pays attention to how a company uses its money. Are they reinvesting in the business wisely, buying back stock at sensible prices, or are they overpaying for flashy acquisitions and diversifying into businesses they don't understand? Diversification is one of Lynch's favorite phrases. It's what happens when a good company takes the profits from its core business and uses them to buy all sorts of unrelated companies, often at high prices, and ends up with a collection of mediocre businesses instead of one great one. As an investor, you want the opposite. You want focused excellence, companies that stick to what they're good at and deepen their strengths. Now, let's talk about the part of investing most people underestimate: psychology. Numbers matter, stories matter. But if your emotions are out of control, you won't be able to follow through on your own plan. Lynch watched investors do something over and over again. They get optimistic when the market is high and pessimistic when it's low. They rush in when stocks have already run up because they're afraid of missing out. They rush out when stocks have fallen because they're afraid of losing more. In other words, they buy high and sell low. Lynch's approach is calmer, almost humble. He accepts that the market will go up and down. He expects corrections. He expects volatility. He expects scary headlines. But he grounds himself in the underlying businesses. If he owns a company with solid fundamentals, growing earnings, a strong balance sheet, and a clear story, a falling stock price might actually be an opportunity, not a catastrophe. He doesn't pretend to know where the market will be in 6 months. He focuses on where good companies might be in 6 years. That time horizon alone gives him a huge psychological advantage. If you're obsessed with every daily move, you're going to be thrown around emotionally. If you're thinking in 5 or 10-year time frames, volatility becomes noise. One of Lynch's quiet messages is this: you don't need to watch the market all day. You're better off reading annual reports, thinking about business models, and going outside to see what's actually happening in the real world. Less screen, more thinking. So how do you actually put all of this together into a practical approach? Let's imagine you're starting from scratch. Step 1. Turn on your radar. Start paying attention to the products and services around you. What are your friends using? What brands are people obsessed with? What companies are quietly everywhere, doing essential work behind the scenes? Make a simple list, not of stocks yet, just of companies you encountered that seem to be doing something right. Step 2. Figure out which of the 6 categories each company belongs to. Is this a slow grower, a stalwart, a fast grower, a cyclical, a turnaround, an asset play? You might not be sure at first. That's okay. The process of trying to classify them will force you to learn more. Step 3. Start reading. Look at the company's latest annual report. Read their shareholder letters. Check basic financial sites to see their earnings history, their debt levels, their PE ratio. You're not trying to become an analyst overnight. You're trying to answer simple questions. Is this business actually growing? Are profits rising? Is the balance sheet strong? Does the current stock price seem reasonable relative to the growth? Step 4. Write the story. Describe the company in a few plain sentences. This is a regional restaurant chain that's been opening new locations steadily for years, with strong same-store sales growth and loyal customers. They're focused on one concept and keep refining it. Earnings have been growing at around 18% a year, and they have little debt. That's a story. If you can't do this, don't buy it yet. Step 5. Decide if it fits you. Even if a stock looks great on paper, it might not fit your temperament. If you hate volatility, maybe fast growers aren't for you. If you're impatient, maybe turnarounds will drive you crazy. You want to build a portfolio that doesn't just look good in theory, but that you can actually hold through the storms. Step 6. Start small and stay humble. Lynch is very open about making mistakes. Not every stock will work out. That's normal. The goal is not perfection. The goal is to tilt the odds in your favor by using everyday knowledge, doing thoughtful research, staying patient, and letting your winners run. Over time, if you avoid the biggest traps and capture a few big winners, the math can work strongly in your favor. There's one more quiet theme in One Up on Wall Street that's easy to miss but incredibly important. Respect your circle of competence. You don't need to invest in everything. You don't have to understand every hot new technology, every complex derivative product, every buzzword. If you work in healthcare, you might have an edge in understanding medical device companies. If you run a restaurant, you might notice food trends or supply chain dynamics before Wall Street does. If you're a teacher, you might understand education technology in a more grounded way than someone just reading about it. Your life, your job, your experiences, they're not a distraction from investing. They can be your greatest asset. Lynch is asking you to trust your eyes, your ears, your common sense, not blindly, but as a starting point. You see a crowded store. You see a product that people reorder again and again. You see a brand that your kids are obsessed with. You see a tool that your coworkers can't live without. Then you ask, is there a strong business behind this? Is it publicly traded? Is it growing? Is it reasonably priced? That's how an ordinary day can lead to an extraordinary investment. Let's bring this all together. Peter Lynch's world is not about guessing where the stock market will be next month. It's about embracing 3 big ideas. First, you, as an individual investor, have real advantages. You can be patient. You can ignore short-term noise. You can look where you already live and work for clues about what's growing in the real economy. Second, not all stocks are the same. By understanding whether a company is a slow grower, stalwart, fast grower, cyclical, turnaround, or asset play, you give yourself the gift of clear expectations. You know what you're hoping for, what could go wrong, and how long you're willing to wait. Third, the combination of solid research and emotional discipline is powerful. When you know the story, understand the numbers, and respect your own temperament, you can hold good companies through storms and let potential tenbaggers actually become tenbaggers. You don't have to be perfect. You don't have to catch every winner. You just have to avoid the obvious disasters, stay curious, and give your best ideas enough time to work. As we close this long-form summary of One Up on Wall Street, I want to leave you with a simple picture. Imagine your future self, 10 or 15 years from now. You're looking back at today, at this moment, when you decided to stop treating the stock market like a casino and start treating it like a collection of real businesses. You remember the first time you walked into a store or used an app or tried a product and thought, wait, is the company behind this publicly traded? You remember writing down your first simple stories for the companies you owned. You remember the times you held on when everyone else was panicking, and the times you walked away when a story was broken, even if the crowd was still excited. That version of you didn't get rich overnight. They got wiser year after year. They let compounding do its work. They used their everyday life as an advantage, just like Peter Lynch suggested. If this episode sparked something in you, if it gave you a new way to look at the companies around you, I'd love to hear about it. What was your favorite idea from One Up on Wall Street? Did any part of Lynch's approach challenge the way you think about investing? And is there a company in your own life that you're suddenly curious to research more deeply? Share your thoughts in the comments. Tell your story. Ask your questions. Your perspective might be exactly what another listener needs to hear. If you found this summary helpful, consider subscribing, leaving a like, or sharing it with a friend who's just starting their investing journey. It's a simple way to support this kind of long-form, thoughtful content, and it helps more people discover books that can genuinely change the way they think about money and business. Thank you for spending this time with me and with Peter Lynch's ideas. Until next time, stay curious, stay patient, and remember, you're closer to Wall Street than you think. It might be as close as the next store you walk into or the next product you fall in love with, if you're willing to look a little deeper.